The Fed's decision to keep interest rates unchanged is pretty much what investors were expecting. No big surprises there. But when will the Fed take any tightening action? Now, that's the question. I want to bring in Danielle DiMartino Booth, CEO and Director of Intelligence for Quill Intelligence. Danielle, tell me, what was your takeaway from what Fed Chair Powell said yesterday?
What I gathered is that the discussion is being had, but he doesn't want to talk about it. So he was clearly prepared when he was asked if the Fed was beginning to thinking about tapering its purchases, and he right out of the bat he was like, "No, this is still not the appropriate time." By the same token, he did recognize that home price appreciation has gone so far off the rails as to harm your entry-level buyer. He also nodded to the fact that companies are having a hard time sourcing employees. So that's another acknowledgement, if you will. It's a tacit acknowledgement, but it's another acknowledgement that wage inflation could become problematic down the line, which is something he alluded to. So it's pretty clear that the discussion has begun, but he does not want to be public about it.
Yeah, you mentioned wage inflation, which we know is key for the Fed. We're seeing inflation, though, pop up in other areas, certainly in raw material costs, lumber being one of them, contributing to those sky-high home prices that you're referring to. But in an environment where inflation is going to be moving up, and at some point we'd imagine wage inflation as well, which companies do you think are best suited, best prepared to withstand that?
Well, I think kind of your counter-cyclical defensive types of companies, people absolutely have to have the products regardless of what the price is. Think healthcare, to take but one example. And in your strongest balance sheet, your strongest cash flow, your dividend payers, those are going to be the kinds of stocks and companies that investors are going to be attracted to in this environment, because they'll be able to do more than talk a strong game by saying, we're going to try and push through these increased costs onto end consumers, but we're actually able to do that. And again, I think that investors will be it's very easy to pick these companies out because, again, they've got these huge cash flows.
Danielle, many companies beat on earnings, but to be honest, many of them did lower the bar. So what do you expect in the next quarters to come when it comes to a lot of them raising prices on consumer goods, and what consumers' reaction is going to be to that?
Yeah, to your point, the bar was on the ground, so all they had to do was tippy-toe over it. My good friend Tobias Lefkovich over at Citi has been speaking about this, that it's not that hard to beat expectations if your expectations are lower to the extent that they were. And we have seen quite a few warnings, whether or not you're talking about Ford or Caterpillar or WD-40. That was one of the first out of the gate saying, we missed on our margins because our input costs are so high. So there's definitely a little bit of a warning flag, I think, that investors should pay heed to. It wouldn't surprise me to see the sell side analyst community in the coming months begin to take down their projections for the second quarter, even when you consider the fact that base effects are going to be enormous, considering where the U.S. economy was a year ago. Think about it. We're in the month of April 2021, when April 2020 was effectively Armageddon.
If the Fed is in wait-and-see mode, what do you think the next catalyst is going to be for this market over the coming months, over the summer?
Well, that's a really good question. Jay Powell brought up something in his remarks that he was looking to the September the 6th expiration of extended jobless benefits as a kind of a source of relief for companies coming down the pipeline, because you are going to pull so many workers who are getting paid more to not work than they would to work. So you're going to see that source of wage inflation begin to come off. The flip side of that is we don't know if there's going to be any type of slowdown in the economy. My good friend at Bank of America, Michelle Meyer, she put out a chart early this morning that showed that the year-over-year change compared to the two-year change in debit card spending from proprietary data there from within Bank of America, they've just about converged. In other words, what will the next source of consumer spending be? if these unemployment benefits are going to roll off, if there's not some sort of into infinity stimulus checks going forward. And I think that that's going to be kind of the next worry point for markets. And it's another reason that we're not seeing, long maturity Treasury bond yields go haywire.
And it'll definitely be most likely another battle in Congress to help the American people as we see some of these benefits start to expire. Danielle DiMartino Booth, thanks so much.